Welcome back again to another episode of the free Forex trading course that I'm doing for my viewers online on my YouTube channel, guys. This is a very basic course. Obviously, I just teach the basics of Forex and support and resistance, how to identify trend, market patterns, candlestick patterns, all the stuff that you see everywhere online. I'm trying to have a playlist on my channel so we can just come to my channel, watch videos step by step to take you through from a complete beginner to an intermediate trader. So with that being said, guys, please, if you do appreciate the content I've been providing, drop a like, comment down below, and consider subscribing. So with that being said, guys, let's just jump into it. The first episode was about identifying trend. So this episode will be about market structure, because once you identify trend, okay, cool, this is a downtrend, we've identified that. So what then? Now it's time to identify market structure. Market structure will help us take entries and will help us to know where are we within that downtrend, right? So you're not lost, basically. So market structure is basically like this. Let me draw it out for you guys. So for a downtrend market structure, it usually starts from a high, a low, a lower high, and then a lower low, and then a lower high, and then the lower low. That is considered downtrend market structure, right? Obviously, in real time candlesticks, it's never that perfect, but this is the concept of it: lower lows and lower highs. So for a bullish market structure, it's usually a low, high, higher low, and then a higher high, and then a higher low, and then a higher high. Now that is a bullish market structure. So now we've identified that. Now, how does that help us? This is how it helps us. We want to be entering at the higher lows on an uptrend, because when you identify market structure, you want to enter here to take a long. And then if it's a bearish market and you've identified it's a downtrend and you'd like to enter, you need to be entering on the lower highs in a downtrend. So in a downtrend, you need to be entering on the lower high. On an uptrend, you need to be entering on a higher low. Now, with that being clear, let me show you a real life example on what I mean by that. We have AUDUSD on the charts, and I can just draw market structure for you guys. You can see here we have a low, we have a low, we have a high, a higher low, and then a higher high. And then market came down, broke structure. So when it makes a low and it breaks the previous low, that is considered a break of structure when the low surpasses the low before it. So now that is a potential break of structure. So now we wait for what? A lower high. And there we have a lower high, because this high is lower than this high, and then it came back down. So remember what I said, we need to be entering on the lower highs for a sell. So if you identify this market structure and you see in the break of structure, this right here is a break of structure, because price went down and printed candles past the previous low. Therefore, that's a market structure, and then it came back up and then it made a lower high, and therefore that's when we enter and take it for a sell. And in this scenario, price came only to the equal low, so it made an equal low. So when it does that, that's when you wait and see, will it continue, will it reverses, what will market do? And then from here, this would be our low. It made a high, break of structure. We see how this high is higher than this high, then came back down, made a what? A higher low. Remember what I said here, we need to be entering buys on an uptrend on the higher low to take it along, to make a higher high. Boom. Then we have another break of structure. See how the market keeps on moving from bearish to bullish, from bullish to bearish. So bullish, boom, we entered, we took a buy, boom, done. Okay, now we have a high, market came back down, broke structure. Now we wait for what? A lower high. Boom, came back, price stopped here, made a lower high, we take a sell to the downside. Boom, another lower high here for another sell. So I hope that was very simple, very clear, because the easier you make it, the easier you'll understand, and the most, if you keep it simple, you'll just understand the concept. Because if you're trying to make it complicated, you're gonna have a hard time understanding what the hell's going on. So keep it simple: lower lows, lower highs, break of structure. Just always do this on higher time frames only, just because on the lower time frame you are more likely to get loads and loads and break of structures and consolidations, and because the higher time frame is obviously more condensed data and it's a more reliable data to go based off. So this episode is episode 2, market structure, identifying market structure. And guys, if you enjoyed today's video, stay tuned for episode 3. We will probably be talking about something else. And with that being said, guys, please consider subscribing, leave a like on the video to help spread the video out to other people and help, so we can help as many people as we can. With that being said, guys, take it easy. Cheers.